Hi everyone, I'm Chris Tipper, Chief Economist and Strategist for the Ainslie Group, and welcome to Ainslie Insights for another week, starting with our precious metals update. This week we're covering the latest in gold, silver, and platinum, with highlights like gold's robust investment demand offsetting jewellery declines, silver's structural deficits fueling minor outperformance, and platinum's breakout rally driven by supply shortages and hydrogen tech advancements. As always, this presentation is brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Let's get started with gold. In the second quarter of this year, total gold demand rose 3% year on year to 1,249 tonnes, with value surging 45% to a record $132 billion amid an average price of $3,280 per ounce, though jewellery demand fell 14% to near 2020 lows, while investment demand jumped 78% on ETF inflows and bar and coin strength. UAE high net worth investors shifted to gold bars, dropping cash holdings to 13% of portfolios, the global lowest, driven by record prices and diversification into physical and tokenized gold, with 57% planning further investments. Central bank buying slowed to 166.5 tonnes in the second quarter, down a third from the first quarter, due to all-time high prices like the $3,500 per ounce, cooling demand, marking the lowest first half since 2022, despite gold's hedge roll post the Ukraine invasion. Gold performed well to end the week on the back of a significantly weaker than expected US non-farm payrolls report, with potential to keep that rally going this week as the market digests the large data revisions. A unique takeaway: amid geopolitical tensions, Iran's gold purchases surged 20% in the second quarter, hitting 6-year highs for coins and bars, and 12% for jewellery as a proxy investment during its 12-day conflict with Israel, bucking global trends. Overall, gold blends resilient investment and regional demand spikes with price sensitivities to economic data and trade dynamics. Silver remains an attractive investment with 28% gains this year, undervalued at a 91 to 1 gold ratio versus the historical 67 to 1, poised for a potential squeeze from 7-year deficits nearing 800 million ounces, driven by solar and EV demand and shrinking inventories. Silver miners outperformed gold in 2025 so far, with ETFs like SIL doubling silver's price gains amid inelastic industrial use, for example 55% of consumption, in solar, which is projected to be 200 million ounces by 2030, and EVs, plus supply constraints from 18-year mine timelines. Prices dropped over 2% below $37.50 US per ounce after the Fed's steady holding of rates around 4.25 to 4.5%, and also amid economic slowdown signals and dual descents. This was the first time that's happened since 1993, while awaiting September cut hints. From here, silver held near $36.60 US on dollar strength from trade tensions and Trump's tariff threats, setting a 4% weekly loss ahead of the US jobs data, which pushed the price back higher. The silver ETF SLV rose 30% since April on tariffs, holding steady post-trade deals with Japan, EU, and China, despite pulling from 13-year highs, with support at around $34.36 US and neutral RSI signalling range-bound trading. Something interesting to note is silver's retail-driven demand contrasts gold's central bank control, enabling rallies twice as large historically, amplified by concentrated miner scarcity down to 20 pure global plays. Platinum group metals offer opportunities in a hydrogen economy, emissions control, and electronics, with unmatched catalytic properties enabling over 60% automotive demand, and an interesting statistic that 80% of small molecule drugs approved by the FDA contain at least one platinum group metal catalyzed reaction in their synthesis, supported by high recyclability and mature infrastructure for cost-competitive sustainability. China's Guangzhou Exchange seeks feedback on platinum and palladium futures trading rules. This also potentially boosts liquidity and demand as a key market if that goes through. Platinum rallied 36% in the second quarter, outpacing gold and silver and nearing 60% year to date via the S&P index, tied to automotive strength and eased tariff concerns post the US-Japan deal. Prices have broke out above $1,400 per ounce with 55% and above gains in 2025, fueled by a 966,000 ounce deficit, which is 12% of demand, 4 to 6% mining drops, and China's 688,000 ounce investment surge, plus 26% jewellery rise as a gold alternative. Johnson Matthey's new Sweden facility for hydrogen internal combustion engines will test catalysts for heavy-duty vehicles, offering 99% carbon dioxide cuts and ultra-low nitrogen oxides, aligning with decarbonisation via collaborations like Project Brunel. This could fuel future platinum demand. A unique insight: despite structural deficits and low inventories, there's only about 3 months demand available. Platinum's thriftiness, low loading, 97% lower recycled carbon footprint, makes it irreplaceable and potentially much more sustainable than base metals in emerging tech. In conclusion, gold shows investment resilience amid regional surges and vulnerabilities. Silver leverages deficits for minor gains and squeeze potential, and platinum surges on supply tightness and green innovations, positioning precious metals as key diversifiers for Australian investors. What are your thoughts on how industrial demand could drive silver and platinum higher by year end? Let us know in the comments. Thanks for watching, and until next week, good luck in the markets.